start this slide. So we're going to talk about the S Corp versus the Dynasty Trust. Can everyone see my screen? I'm sure you can hear
Yes.
me.
Yeah.
Everyone see the screen? So someone needs to be muted. Okay, awesome. All right, no feedback. So we're going to go over that. Quick disclosures, just like every other call we have, nothing in here is, tax, legal, or financial advice. You don't get that until you hire us. Once you hire us, then we do provide tax, legal, and financial advice. But when you're on these calls, these are really just for educational purposes. We're going to go over some examples of stuff. Everyone's situation is different, and unique, and all that stuff. So just kind of keep that in mind. Now, and I'm going to have Michelle drop this in the chat as well. But we have that masterclass. It's in the process of getting edited right now. It should be ready in the next few weeks. So once it's available, make sure you send an email to Amanda right now. So once it's available, she can email that over to you. And that's going to go into detail with a lot of different things about the trust. And we also have a PDF document with FAQs and all these different things. So you can really do your due diligence. Take it to your CPAs, take it to your attorneys, whatever. Whole point is for you to really have a good understanding of not only how this works, but how valuable it is, how powerful it is, and really how it can change your business and your life. And always to subscribe to Trust Tuesdays. If you know anyone, everyone that's on this call is already subscribed. But if you have any clients, friends, colleagues, people you work with, you think this will be very interesting for them, have them sign up for the Trust Tuesdays subscription so they can get alerted for these calls every week. And I'll have Michelle drop those in the chat. So quick background for those of you guys who don't know who we are. We're Prudent Wealth Strategies. My name is Stefan Bellholm. Michelle Nice, who is my wife and also business partner and everything above. She's definitely my better part, does a lot of things much more efficiently than I do. And together we work with, our team. So we have a whole back office of forensic CPAs, tax attorneys, strategists, bookkeepers, that this is all they do. They set up these unique, tax structures for investors, for business owners. We collaborate with a lot of tax firms around the country to help people utilize these lesser known structures that a lot of people think you have to be uber super wealthy to take advantage of, and that's just not true. We are located in Pinehurst, North Carolina, about an hour and a half from the Raleigh area, about 2 hours from the Charlotte area. But we have clients all over the country, and we service them nationwide. And a lot of these structures, the Dynasty Trust specifically, can work in other countries. So if you have clients that have properties in, Canada, Mexico, any country that does comply with contract law. There are some countries, Russia, China, probably not so much, but there are a lot of countries where you can hold assets inside of these trusts and get the same asset protection that you would here in the United States. So the structures that we work with are, things like trusts, special purpose vehicles, private foundations. A lot of people that may not think that they're charitably inclined. It makes there's a lot of good reasons to become charitably inclined for tax purposes and for asset protection purposes as well. So there's just a lot of different structures that we work with our clients. But the main goal is to show them how to keep more of their money, pay less taxes, grow generational wealth, and just do things a lot more efficiently. And again, you don't have to be a gazillionaire to make these things happen. So we're going to go and dive deep into the Dynasty Trust. But let's kind of talk about S Corp. So an S Corporation, what is an S Corporation? First of all, who here has an S Corp? I think Christine said she had one, I believe. Does anyone else here have an S Corp? Raise your hand or unmute yourself, say, yes, I have one, whatever.
I do not, but I was looking at getting one for an RV park that I was purchasing. That's why I was wanting to hear more about this.
Perfect. Yeah.
They do.
So you have an S Corp. Okay, Carrie. All right. Awesome. So the S Corp, and just so you know, I've been in the tax business for quite some time. And before I got in this business, I was an entrepreneur. I, have different businesses. My dad's an accountant, so that's kind of not the reason why I got into the tax world, because taxes are boring, they suck. But when you start to make money, this is, the first thing you see is, hey, I'm making a lot of money. I have to give half of it back to Uncle Sam, right? If you're self-employed. So the biggest thing that most CPAs and tax professionals will tell you is to go set up an S corp, because it's going to save you money in taxes. But the main thing I try to get people to understand is that an S corporation is not an entity. Okay, it's just a corporation. It's a corporation with an S election. So you can choose to have it as a regular corporation or a corporation with an S election. That's what an S corp is. Okay. So it's not really an entity. It's an election that you can choose to change. So if you're an LLC, you can choose to be taxed as an S corp. You can choose to be taxed as a C corp, partnership, what have you. But it's just a taxable, it's just a tax designation election. It's not an actual entity. Your entity is going to be either an LLC or a corporation. But that entity, nonetheless, is going to be a statutory entity, which means it's going to be set up on the state level, right? In North Carolina or Florida or New York, Texas, wherever you're set up, that's where you're going to be establishing it, which means that you have to abide by all the rules and regulations with those changes. One of those changes this year, that got instituted this year, was the BOI. Is anyone familiar with the BOI? Anyone had to deal with that? Anyone filled the paperwork out with BOI?
I did.
Yeah, it's a pain in the butt. And if you don't do it, there's a stiff penalty, right? So the BOI was basically a new thing that was instituted with, basically part of the SEC, but not really. It's the FinCEN, but they want to know who's part of every corporation. This is the government taking one more step to figure out what's going on, kind of peek under the hood, and take away a lot of the privacy that you want to have as a business owner. And we'll talk about how this relates with the trust, because the trust gives you a lot more privacy than any statutory entity. But the main thing to understand is that whenever there's a change on the state level or anything like that with the corporation, S corp, C corp, doesn't matter. You have to deal with that. So the advantage, obviously, with the S corporation, why do people do it? Well, it's number one, you don't have to have that corporate taxation, right? Which is why most CPAs will say, hey, don't do a C corp if you're just a small business, because you're going to have that corporate tax. You do a S corp, you don't have that corporate taxation. Everything just goes through your personal. And it also reduces your payroll taxes, because again, if you're self-employed, if you're 1099, like a lot of people that are realtors or, in sales, whatever, you're paying 15.3% in self-employment tax, payroll tax, on top of your federal and on top of your state tax. So it's a huge amount of tax that you're paying if you're, making a decent amount of money. So an S corp helps to mitigate that. And then obviously the protection. Hey, you have that corporation, you can kind of, protect your things in your personal name to an extent. So that's the reason why people do a corporation, or that's the belief that they think of why it's beneficial to do an S corporation. The downside is it's complex, right? There's lots of different nuances, different filings that you have to do. You have to fill out a separate tax return, 1120S. There's a cost to that, bookkeeping, all these different things. So there's an extra layer of things that you have to figure out when you're an S corp versus if you're just by yourself, right? And then that protection is limited. Okay, and we'll get into that in the next slide. But S corporations can be pierced. Okay, we like to say LLCs are a large lawsuit coming, right? Not limited liability corporation, because LLCs can get sued and get pierced, and it happens all the time. It's happened to me before. So a lot of the stuff that when I talk to people about this stuff, it's because I've been through this personally. Okay, I have a Dynasty trust myself now, but if I didn't long time ago, and if I would have known about this, it would have saved me a lot of headaches, a lot of taxes, a lot of different things. But that's neither here nor there. But the S corporation does the protection is limited, okay, and it requires you to pay yourself a W-2 salary. And we'll get into why that's not such a good thing when it comes to the trust. But the other thing is, a lot of people that have S corporations, they're saying, okay, I'm going to pay myself I make, $300,000 a year. I'm a doctor. I'm going to pay myself $10,000. We see this happen all the time. Well, guess what? The IRS is coming down hard on S corps that are not paying themselves a reasonable compensation because there's IRS guidelines around that. Even though the IRS doesn't specifically say, hey, you have to pay yourself this amount of money. There are different requirements and ways to calculate what you should be paying yourself as far as a W-2 salary. And the IRS is starting to come up on that a lot more. So LLCs, again, this large lawsuit coming because any attorney or CPA will tell you to get an LLC or to get a corporation to separate yourself from that property or for that business, right? Separate the shareholders, the owners from that. But anybody that wants to sue someone, if they're smart, they know that they can sue not only the members, but I can sue the operators, I can sue the owners, I can sue the directors, right? There's all these different ways that people will try to set up LLCs or corporations in different states like Nevada or Delaware or South Dakota, Alaska, whatever, to try to mask or mitigate being sued. But the reality is, if someone really wants to sue you, they can. And it's just how they do it is gonna, depend. The end of the day is if you own shares, you have things in your name, you have ownership, that's not good. And ownership is not your friend. This is the whole own nothing, control everything concept when we talk about the trust. But as long as you own something in your personal name, somebody can take it away from you. So LLCs and S corps don't have as much protection as you may think. And one of the biggest reasons why LLCs and corporations get pierced is because of alter ego. Has anyone ever heard of alter ego? Anyone? Nobody has heard of alter ego? Okay. So,
Nope.
okay. So alter ego, it's very simple, and you can Google this, okay? What this means is that you have a business, right? So you have an S corp, you have an LLC, whatever. You're running things through, people pay your LLC or S corp, all the invoices, expenses get run through there. But it's technically an alter ego. It's like you wake up, you think you're this person, but it's like Dr. Jekyll and Mr. Hyde, essentially, is what happens. So you have a corporation, but you're not running it like a corporation. You're not doing, your monthly minutes and meetings and the recording and bookkeeping and all the things that you're supposed to be doing to make it work the way it's supposed to work. And what happens is if the court or the judge says that, hey, okay, this person tried to sue you, the first thing they're going to look at is all of the paperwork and requirements that you're supposed to be doing as an LLC or as a corporation. And if you're not doing that the right way, the courts are going to consider it an alter ego. Basically, where you may think it's a business, but since you're not doing the things that you're supposed to be doing as a business, we're not going to treat you like a business. That's the easiest way to kind of explain it. But this is the easiest way to pierce the corporate veil. That's the term that's used. You can Google that, piercing the corporate veil. And it happens all the time. On average, it's about 40% of the time that LLCs get pierced. So it's really not the best way for people to hold properties, especially real estate. A lot of people will put real estate in an S corporation. Not so good. We won't get into the weeds into that. But the whole point is, from a litigation standpoint, your assets can get taken away from you. But the trust gives you a lot more flexibility because you don't have all of those requirements in corporate meetings and minutes. You don't have to deal with the BOI like you do with an LLC or an S corp. Okay, but everybody's situation is different, and sometimes it may be so. Even though we're talking about why LLCs and S corps suck. There may be a reason for you to have that entity structure for various reasons, and we'll go into that. So just to give you a 30,000-foot view of the differences when it comes to the tax standpoint, let's say someone, you're sole proprietor, married, filing jointly. I'm not including any state tax, so let's just assume this is like Florida or Nevada or any state that doesn't have any state tax. Obviously, if you're in North Carolina, like I am, and a lot of people on the call, it's even more. But let's say your net income, so after expenses, after all your deductions from your business, is 200 grand. Well, if you have a sole proprietorship, yeah, it's about $51,000 in taxes. It's a lot of money. And you can see the majority of that, the bulk of that is because of that self-employment tax, which is again the reason why if you go to a CPA, you go to a tax advisor, whatever, they're going to say, hey, do an S corp if you're starting to make money, right? If you're making, $10,000 a year, it may not be, beneficial for you to set up. But once you start making good income, then go ahead and do an S corp because you're going to save a whole bunch of money in self-employment taxes. And that is true, okay? Because with an S corp, again, you have to pay yourself a required compensation or salary, basically a W-2 salary, and that's what you're going to pay the self-employment tax on, not on the whole amount. And part of that self-employment tax is a deduction to the corporation. Okay, so there is no corporate tax, number one. So everything flows down to your personal estate, right? Your personal tax return. But the biggest thing is that you're not getting killed with self-employment taxes. So if we look at the comparison, same $200,000. Again, if this person is paying themselves $50,000 salary and taking the rest as a distribution, then they're going to save a considerable amount of tax, right? About $14,000 in taxes. But if we look at a dynasty trust, it's a much better thing because, and the calculations are a little bit skewed here. Again, we're just showing as a $20,000 net income, they're probably not going to pay any federal tax because of the standard deduction and things of that nature. They would just have to pay a little, payroll tax. But huge difference on the same amount of income that you're taking. But the reason why, and this is when people kind of start to understand this, and I don't expect everybody on the call to get this stuff right away because it took me a while to understand this. But there are rules that have to be followed when it comes to understanding how and why to use a dynasty trust. And the first rule is,
Hold on, Stefan.
Yeah.
I just want to stop you right there and see if go back to the last screen, please.
Yeah.
And see if there are any questions on that. If everyone understands the power of this slide right here. You have $200,000 of net income and just, look at this, look at the tax due at the bottom, the totals. Sole proprietorship, making 200,000, 51,940 due to the IRS. S Corp taking a $50,000 a year salary with $150,000 distribution, K1 passive, you owe $36,491. Dynasty Trust, here I have to minimize this. Look at this, $20,000 income. You control your income when you have a dynasty trust, and that's how you control your taxes. Total due, $2,341. Look at that. Are there any questions on that?
Yeah, I have a question. So when you're saying there's 20,000 K income, are you running a P&L inside the Dynasty Trust that you're expensing all of the stuff to, that you're only showing a 20K income? And is that a pass through to your personal tax return?
Not necessarily. I'm going to get into that because the Dynasty Trust isn't going to pay yourself an income. So what I really want to get people to understand is, hey, this is a different way of doing things, number one. Number two, once you understand the benefit of why you want to do things this way, this will make more sense. But long story short is when you have, people that have LLCs and S corps typically have active income, right? They have a business, real estate, sales, pharmaceutical sales or physician, whatever. They have an active income source. And we can take, and this actually could be more, but again, everyone's situation is different. We can make it so that we can suck about 90% of that net income into the trust. I mean, it's a huge amount of income that you're not paying taxes on. So you're only paying taxes on 20% of your income. But that income is going to be different depending on how you're structured. Most of the time, it's what's going to make sense at the end of the day is for you to have an LLC, but have it be taxed differently, typically as a partnership, not an S corp. But that's what's going to happen is that income is going to be coming straight, same from your business, but it's not going to be as much. Does that make sense?
Maybe keep going.
Well,
Uh,
Yeah,
people,
I
get
think
into
we
that.
need to dive in more. So
Yeah.
then it'll make sense. Yeah.
Yeah, but that 20,000, we could, maybe you need to pay yourself more money. Maybe it need to be 50,000. Maybe it's 100,000. The whole point is you have a lot more control over how much income that you need in your personal estate with the Dynasty Trust. So let's get into the trust rules, because then all of this stuff is going to make more sense. But rule number one, and this is really the key behind a lot of the planning that we do with our clients, is never pay more taxes than what you live on, what you absolutely need to live on. What I mean by that is, okay, how much do we need to pay for our groceries? How much do we need to, the kids we just did back to school shopping. That's a doozy, right? All these different school supplies that you have to buy and they never end up using. So, all these different things that you actually need to live on. We know what your business does. We know all the things you can write off in your business, your cars, all that stuff. We'll talk about why the trust is better, but never pay more taxes than what you live on. If you're a W-2 employee at a company, you don't have a choice, right? If you're making $200,000, you're making $200,000. There's nothing you can do. You're making that money. You got to pay tax on it. You can save a little bit here and there, put it in a 401k IRA, but that's pretty much it. But as a business owner, as an investor, as an entrepreneur, you have control over different things. So never pay more taxes than what you live on.
Stefan, let me just expand on that for real quick.
Yeah.
And something very basic to understand is that people and money are not taxed. Your income is taxed.
Yep.
So when you control your income, you take more control of the tax you pay to the government. So who wants to have more control of what they pay to the government? More control of what they are able to keep.
That's the key. That's the key. That's the key right there. So, but rule number two is really the crux of all of this, is to own nothing but control everything until you die. Anything that you own in your personal estate, right? You have to work, you have to earn money, you have to pay taxes, and then, buy your house, all that stuff. We'll talk about that. But you have taxes, liabilities, and lawsuits. That's not a good position to keep yourself in. But you do want to have control, right? And this is the whole concept of the Rockefeller rule, not just the Rockefellers, the Kennedys, the Wrigleys, the Gettys. All of these wealthy families have been doing this for decades, is they understand that ownership is not your friend, okay? Second part of that is if the trust owns it, right, which is a position you want to be in, then the trust pays the bill. So all those things that you pay for typically in your personal estate that you have to, again, earn money, pay taxes, right? And then have that money to pay those bills. You don't have to do that when you're using the trust estate, okay? So you never want to pay with after-tax money as much as you can. Why do that when the trust can do the same darn thing with pre-tax money? It's just, it's a no-brainer. And a lot of people get it, but they don't understand how to do that. And that's because they're not using the right vehicle. You can't do that when you have an S Corp, when you have an LLC, when you have a C Corp. And the trust can pay for a lot of lifestyle expenses. We'll get into that with pre-tax money. So a lot of the things that you pay for, again, your expenses, your bills, investments, the trust can pay for those things. Now, the trust can't pay for everything. Okay, and we'll go into that. Trust can't pay for what we call food, fun, and fashion. You want to take a trip to Disney World, you want to buy some Jordans, a Gucci purse. Those aren't trust expenses. But the trust can pay for your health insurance. The trust can pay for your medical bills. The trust can pay, you got kids going to college, you got kids in private school, you need to buy school supplies, they're going on a field trip, they got piano lessons, all these different things. It adds up, right? The trust can pay for all of those things with pre-tax dollars. So you don't need to operate in your personal estate like most people, because again, your personal estate, you have taxes, liabilities, and lawsuits. Trust estate, the Dynasty Trust estate specifically, not a living trust, not a revocable trust, because you can't do that in those types of trusts. It gives you access, benefits, and control. Most people have trusts specifically for the reason to avoid probate, which I'm sure Christine can tell you about that work with her clients, right? Probate is horrible, right? So that's why most people set up trusts is to avoid probate, make sure their heirs can get their assets without having to go through courts and lawyers and judges and, getting all their money sucked away. But the wealthy people use trust without having to die. They use trust while they're alive. And that's really what the dynasty trust concept allows you to do. So again, most people work, earn money, pay taxes, and then pay for all these different things, all their expenses, all their bills, all their investments with after-tax dollars. Trust estate, we're just flipping that on its head. We're doing things differently because we're operating in a different estate. Okay.
Different
Yeah,
entity.
we're doing it, different estate, right? And we're doing it with pre-tax dollars, which is a huge savings, right? So when we're paying for all of those expenses that we typically pay for, and we're going back to here, right? If I'm at 25, 30% tax bracket, if you're in California, it's even like 40, 50%. We have a lot of clients out there. And I'm able to do the same things on a pre-tax basis. That's a huge saving. I'm saving, 20, 30% on every darn
Every
thing.
bill. Every bill, like your light bill, the bug guy, the pool guy, you need a new roof, you're flipping houses, you're renovating the flooring, the furnishings, the paint, everything. If you have a note on your home still, the mortgage, you can pay for that with pre-tax dollars.
Yep.
Think about that. That's a 25, 20, 35% tax savings on every single bill you have.
It's huge.
Homeowners insurance.
The more you make, the more valuable it becomes, because once you start to hit those higher tax brackets, and we just showed someone, making 200 grand. We have clients, six, seven, $800,000 a year easily they're making, and they're getting taxed out the wazoo, even with S corps. And so the final slide, and we'll get into some drawings because I really want to go over a lot of Q&As. I'm sure a lot of people have questions. Is with an S corp, it requires distributions. Okay, even if you can save some money on the back end of not having to pay payroll taxes as much as if you're self-employed, you still have to take money out of that. If you're making a huge amount of money, those distributions can add up and cause your tax bill to go high up. Dynasty Trust does not require distribution. So if I'm making $1 million in my business or from my real estate investments or whatever, I can keep all those earnings inside my Dynasty Trust. I don't have to distribute those things out. Okay. And I can use that to go buy more real estate, buy more investments, do whatever it is to grow my wealth exponentially. That's what the Dynasty Trust allows you to do. And I can do it for generations, right? Because with an S corp, you can't defer the tax, right? It's not, and this is one of the reasons why people will say, okay, let me go put money in a solo 401k or a SEP or Simple or whatever. And we have other trainings that go over that and why the trust is much better. Hopefully you're already beginning to see that. But I can defer the taxes with my Dynasty Trust for generations, for decades. Okay? That's really the value with this. No payroll taxes. I don't have to, deal with that. And then I get ironclad asset protection. So no one can pierce through my Dynasty Trust if it's set up properly. A lot of people don't set these things up properly, and that's another thing to understand. But if these things are set up the way they need to be, no one can touch it, because none of the assets in the Dynasty Trust are owned by you. Again, own nothing, but control everything. So with the Dynasty Trust, you are the trustee. Okay, you have ultimate control. Or if you're married, you and your spouse are co-trustees, but you have all the control. Okay, but nothing in the trust is owned by you. It's held for the benefit of the beneficiaries, but it doesn't have to be distributed to your beneficiaries in your lifetime or in 1,000 years. Okay, that's why these things work the way they do.
So I just want to emphasize on what Stefan said about the asset protection. Okay. I just really want to drive this home, because this is the entity you want for ultimate ironclad asset protection. It would be like somebody going coming to your house and saying, hey, I want your neighbor's car. You can't give them your neighbor's car. Why can't you give them your neighbor's car? You don't own your neighbor's car. That is the concept. You don't own it. So they can't get it. You're protected. Does
Yeah,
that
and
make sense?
that makes sense.
We're dealing with eminent domain right now in the town we live in.
Yeah. That's a huge thing with these trusts is the potential to get protected from eminent domain. So all of you people in real estate, you definitely want to have conversations with your clients about this, because if they're in an area that is getting developed a lot, and they're thinking to make some plans to change some things, and it might impact them once you have their assets or their real estate in these dynasty trusts. Good luck. Them trying to get it. I mean, there's just so many uses with this. But from a tax standpoint, and I'll go into drawings after this, the main thing to understand is that these dynasty trusts can only take in passive income. So capital gains income, rents, interest, royalties, dividends, passive K1. And I'll explain that when I go into the illustrations. But that's the only type of income that can go into it. Active income, W-2, 1099, 1099-R. That type of income cannot go directly into the trust. So, which is why, again, when you have an S corp and you're required to pay yourself, a W-2 salary, and let's say your CPA is saying, hey, you need to pay yourself 75,000 or 100,000, whatever. That's a huge amount of money that you cannot put in your trust if you don't need to live on all of that money. There's just lots of different nuances, but the main thing to understand is that we have to, for active income purposes, find creative ways to structure that income and to get it into the trust. But we can do a huge amount of it, like I said, up to 90%, sometimes even more, depending on how your business is structured. But again, you're going to need some money to, for food, fun, and fashion. Hey, you need to go buy groceries. You need to go, we want to go on vacation, things of that nature. So there's things that you're going to need in your personal estate. So having money here isn't bad. You need money here, but we don't want a whole lot of money in here. Why? Because you have taxes, liabilities, and lawsuits. So
And it's much better to say 10% taxes on 10% of your earnings or 30% of your earnings than 100%.
Than 100%. Period, point blank. So that's it. We will kind of go into Q&A, and I'll draw some things out. And Michelle, make sure if you haven't already dropped the link in for some people, because I'm sure some people
I believe I have.
Drop the link in for the Dynasty Trust evaluation calls, because that way you can get some one-on-one time with either myself or Michelle. We can go in a little bit more detail in your situation, seeing if it's a fit. At the end of the day, this isn't a fit for everybody, but really making sure you guys have a clear understanding about how powerful this is and how impactful it is in your life or your clients' lives as well. So with that being said, we'll just open it up for Q&A, and I'm going to go into some drawings. I know Christine had a question about distributions. But
Yeah,
anything?
just to be a little bit more clear. So the Dynasty Trust, so what if you own businesses? Like when I say we have an S Corp, my husband has his business in an S Corp.
Yep.
So that's how he's functioning. So when you have a business, does can the business be in the Dynasty Trust?
No, we're not. And that's what I want to go in. I want to address that right off the bat, because there's a lot of stuff. And unfortunately, we live in the internet age of, Instagram, clickbait and all this stuff. And you see a lot of stuff with people, getting an LLC, put your LLC in the trust. You never, ever want to do that. The trust, for it to work from a legal and tax standpoint, because again, we don't want distributions. We cannot have any active income. And pretty much every LLC is going to have an active member or whatever. So we don't want that LLC to be in the trust. What we do want is to suck income from that LLC or that S Corp into the trust. And that's what I want to go over. But no, we're not going to put that LLC inside the trust. So the trust can own a lot of investments, a lot of different things, but we're not going to have it own any LLC interest. So clear all this stuff here. So the easiest way for me to kind of explain how this works is, again, this is, you over here. This is everybody in the U bucket, taxes, liabilities, and lawsuits, right? So we want to operate in the trust estate. But from the LLC standpoint, how that works is going to be different for everyone's situation. It can work a little bit with S corps, and I'll get into that. But typically, this is the easiest way that we're going to want to do this, okay? Because again, we have to create passive income, okay? We cannot have active income into the trust. It has to be passive income. So what we're going to do is keep an LLC structure or corporate structure, but have it taxed as a partnership, okay? Not as an S corp. Why? Because I don't have to pay a W-2 salary, right? We don't have to have that required, salary every year and things of that nature. But we can keep that LLC structure operating the way, the way it is. But again, we're just going to change the tax election from a single member to a multi-member, right? So multi-member partnership. And what we're going to do is we're going to have the individual, or if it's two people, individuals, as managing partners or general partners, okay? But what we're going to do is have the trust structure, okay? So the trust structure is going to have a limited partnership interest, an LP interest. So think of it like almost like a silent investor, right? When you have a company, Shark Tank, whatever, hey, I'm funding you money, we're going to get a return on our investment. So all this is done contractually and legally and all that good stuff, but we're keeping the LLC structure operating as it normally is. We're just changing the tax election to reflect a multi-membership LLC with a general partner, which would be you, okay? So that's where that 10%, and again, this is an up to number. So really understand that this is all about tax control. And that's one of the things that we talk about in the master class, is having tax control. So, hey, if you need more money for food, fun, and fashion, whatever, okay, we can go ahead and do that. But we can do up to 90% going into that limited partnership interest into the trust. Okay, that's a huge amount of money. We can actually do more with most people because they're going to have what's called a dual trust structure. So they're going to have two trusts operating. And this is another thing to understand, because you can, depending on how you're set up and what kind of businesses that you're running, you could actually run your business as a trust. Okay. Perfect example of this is John Rockefeller, Standard Oil Trust, right? He operated his business as a trust. Hershey's Trust Company. I mean, you can Google all of these companies out there that operate still even today as trust. If you're into golf, is anyone a golfer here? Or played golf or like golf? Any golfers here? No? I'm the only one? Okay.
Just you.
Okay. So if you know anything about, we got the British Open coming up, right? In Scotland, in St. Andrews. And St. Andrews is operated under trust. It's called the St. Andrews Links Trust. So long story short is there are, depending, most of the time it's going to be, hey, if you have a business that requires licenses, right? Like you're a realtor, or you're in insurance, or you're a CPA. A lot of the times there may be rules and regulations around operating as a trust. They may not let you operate as a trust. Some industries, some licenses let you, different states, again, statutory nature. These trusts are not statutory. So we won't have to deal with all those different things like LLCs and corporations, BOI, as Carrie alluded to, having to deal with that. You don't have to deal with that with the trust.
So Stefan, if you are one of those business structures where you have a license, that's when you want the trust to be a limited partner
Exactly.
and you're the
So-
general partner.
Exactly. So
You can
we'll
operate via, with the trust, but you're not operating
exactly.
as a business trust and then, flowing down to a beneficial trust.
Exactly. So essentially we'll keep everything running through the LLC. So if you need to, we're not going to burn everything to the ground. We'll just keep your LLC structure and just change it instead of an S corp election to a multi-member and a partnership election. And then we can get the income into the trust from there. But the point is we could even take more than 90% when we have a dual trust structure, which is going to be the case for most people, because this dual trust structure, this trust at the top is what's called a business trust. Okay. So it's essentially operating just like a flow through, just like an LLC. So a lot of clients that I have a landscaper guy, he's got a landscaping business in Georgia. He's operating all his stuff. Last year, he just finally changed everything over through his business trust. So everything gets done, all the invoices get paid to the business trust, all the expenses, payroll, everything gets operated through the business trust. And at the end of the year, all that income flows through, but it doesn't flow through to you. Okay. It flows through to your beneficial trust, your main trust. So there's different ways to do it. And again, that's when we'll have kind of, one-off conversations with people. But the whole point is that this is about tax control and having access, benefits, and control of your money and not being in the realm of taxes, liabilities, and lawsuits. Did that answer your question, Christine?
Yeah, it does. In a general sense, yes, it does. I mean, me personally, there's a lot more going on, so I would definitely do one off just to, but for the most part, I get the gist.
Yeah, main thing is we're not putting the LLC in the trust. The trust is only going to hold,
Yeah.
your real estate. It's going to hold your investments. You do oil and gas, cars, any assets that you have, you put those things inside the trust, and all the earnings, the rental income. Hey, if we have a capital gain, we bought it for 200,000, now it's worth 2 million. Okay, if we sold it over here, we're playing cap gains, right? If we do it in the trust, no cap gains.
How does that work for rental income properties that are in the trust from a liability standpoint?
Much better asset protection. So if something happens, yeah.
So each property would actually just be owned by the
By the
Dynasty Trust, and then so do you have to operate on with a P&L for those, or how do you, from a tax standpoint?
Yeah. So and that's the thing to understand. And when I talk to people about the trust, I really try to relate it to, yes, it's a trust. It may seem, highfalutin, you got to be super wealthy, super complex. No, it's really no different than your LLC. So you're gonna, or your S corp. So you're gonna file a tax return every year. Okay, it's called a 1041. Okay, not a 1040, right? But a 1041. It's for trust and estates. Your LLCs, your S corps. What do you file? You file 1120S. So you're filing a tax return the same way. It's just with this, because we're keeping all the distributions. We're not distributing income, rather. We're keeping it inside the corpus of the trust. We don't have to pay those huge taxes like LLCs and S corps that go down to your personal estate. So you're filing a 1041 every year. You're going to do P&Ls. You're going to have a balance sheet, right? You're going to have an EIN number. You're going to have a bank account. So it's really no different than operating in an LLC or a corporation. But yeah, there's different nuances and things and how to get worked out. But you're just operating in a trust estate and doing as much as you can in your trust estate, knowing that, hey, there's a lot of different things that I'm paying for right now out of my pocket, and I'm paying for with after-tax money, and it's costing me a lot of money that I can do in the trust, and it makes way more sense.
So at the end of the year, when you do the taxes, if the trust is in a gain, the trust does not pay taxes?
Yes, because we're keeping all of the gains. So the main thing to understand here is
it's a paradigm shift in thinking, right?
It's a huge paradigm shift. And that's literally majority of our job, it's like we're like counselors, is is that paradigm shift of and again, it took us a long time to understand this and then to incorporate it in our lives. Especially having that tax background and understanding, hey, because we used to do the same thing. Oh, hire your kids,
Cost seg,
cost
depreciation,
segregation,
all of that.
depreciation, all of these different things.
Don't
But
have to do that.
trust, it
Yeah.
takes all that stuff off the table. So the long and short of it, how it works is we have a capital gain, right? It's it's worth 200,000, but now it's worth we bought it for 200,000 rather, but now it's worth 2 million. Okay. That we sell it, the other person has the house, right? Excuse my handwriting. But now that $2 million is going to go back into the corpus of the trust. We're not going to take distributions this year from the trust because these trusts, Dynasty trusts, do not require distribution. If you have a living trust or a vocable trust, charitable remainder trust, those trusts require distributions every year. Now, if you do take a distribution, you're going to pay tax. Okay. So you're going to pay tax.
Take the distribution, but you're going to be taxed on it.
Yes.
Okay.
So the whole point is we don't want to take distributions because the trust can do a lot of things that we don't need to take distributions for.
How does it work when you want, say you have inside the trust, you see an investment property that you want to buy, but you don't want to pay full cash. So now you want to get a mortgage. So how do you work with a mortgage with the trust? Because how are you showing income?
Yeah. So, and that's one of the things to understand with having tax control, right? Hey, I might need to get some financing, and Carly can talk to you about financing and where to get money and banks and all that stuff and how all that stuff works. But okay, do I need to show money on the personal side this year or whatever? Okay, how does that work? Especially with respect to all the businesses and all the active income that you're earning. But a few things to take into consideration. Number one, the way we get every asset inside the trust is we do it through a sale. Okay, we're not gifting anything over. There's no gifts inside this trust. So this is not a grantor or grantor trust. We're not gifting or granting anything. We're doing an actual sale. Okay, so when we put assets in the trust, there's going to be a notarized bill of sale. There's going to be a purchase and sale agreement. There's going to be a contract. There's going to be a deed, or warranty deed, quitclaim deed, whatever it is. So this is an actual financial transaction that's happening. But when we do that, we're doing it at whatever our cost is. So going back over here, this is the U bucket, right? If your cost for that real estate, let's say, was, it's just, in this case, $200,000, right? You bought that property for $200,000. We're going to sell it to the trust for $200,000. Now, that being said, we're also going to take into consideration your improvements, right? If you put $100,000 in improvements, we're going to add that in, right? If you took depreciation, this is the downside of the depreciation. What we like to say is for every gimme, there's a gotcha, right? If you have real estate, you took depreciation, did a cost segregation or bonus depreciation or whatever, right? It saves you some taxes on the front end, but when you sell, you're getting killed with the capital gains plus the depreciation, recapture, Obamacare, all that stuff. So with the trust, we do have to take that in consideration, but we're doing it at cost. We're never creating a gain when we're selling everything over. So there's no gain here. Okay. We're always doing it at cost because we can do this because this is a private transaction. Even if that property is worth 2 million or 20 million, doesn't matter. We can sell it for whatever we want. So we're going to choose the cost method because that's the least expensive approach. So the trust is always going to owe you money for everything that you sell everything over to it. This is what we call a demand note, which is basically a fancy IOU. Okay. It's a note payable. So going back to the bookkeeping, payroll, profit and loss statements, we have a note payable account and balance sheet. Okay. So there's an IOU every single time that you sell everything over that the trust owes, because initially when you set up the trust, there's no money, right? There's just assets in it, things in the trust. So once income starts to come in from the rental properties, right, from the capital gains, from the interest, from the stocks, you like crypto, you like oil and gas. We're going to have an oil and gas guy on here in a little bit, in a few weeks. all of that, all those earnings, you're going to start having money in the trust that's not going to be taxed. Then you can take money from the trust into your personal estate. So if I need, some money to go get financing for a down payment on a house, you can go take from that demand note, right? The trust owes you 200,000 or 300,000, whatever you sold it to the trust for. And it's not taxed. It's not a distribution because the trust owes you that money.
Okay.
Makes sense. So there's lots of different nuances and different ways. You could pay yourself a salary from the trust as well because you're the trustee, right? Your job is to grow the trust for your beneficiaries, right? So, you can pay yourself a salary because a lot of people will hire trust companies, right? You know this in the field that you're, right? That's not such a good thing because, right, they could legally run off with your money. Most of the time it won't happen, but it does happen. So we want to train you how to be the trustee, but you would hire a trustee and they would be paid a wage as well. So you can do the same thing. So there's all these different nuances and ways to get money out of the trust if you need to get financing and things of that nature. But you're going to have a crap ton of money inside the trust. The trust can do, a lot of people like to do infinite banking, bank on yourself, supercharged life insurance. You can do that in the trust, pre-tax dollars. If you
do
want
life insurance in the trust, borrow against your life insurance.
Yeah. You can do financing. There are some banks, not a whole lot, but there are some banks that will lend to trust for financing. It's mainly going to be for primary residences, not, real estate investments and things of that nature. But there's always a way to make it work. So again, everyone's situation is different, and we have to kind of customize and plan things around that. But that's kind of how things work when it comes to, the financing aspect. Any other questions? I know it's a lot and we're a little over time. See, what about imputed interest is the note process? Yeah, so yeah, there's going to be a interest charge with the, we can't give a loan with no interest. That the IRS requires us to charge interest. So typically what we're going to do in the trust is use either the applicable federal rate or the federal funds rate for that interest. And that's going to be growing inside the trust. So just know that when you're selling everything over to the trust, your demand note is going to grow over time. So that's another thing to kind of consider. And again, you don't pay taxes on anything that's principal because the trust owes you that money. If it's interest, then yeah, you would pay interest, income, on your personal tax return when you take that away. But a lot of people, I got a guy now, he's 67. He's just sold. His real estate portfolio is about 14, 15 million. He's got a cost base. So his demand note is about 4.5 million. Okay. And he basically told me there's no way in heck he's going to use all that up in his lifetime. He's just that type of person. So different people, different strokes for different folks, but just know that there's ways to make it work. It's a good question, Jim. Any other questions? Oops. All right, well, that's it. I want to thank you guys for coming. We're at the top of the hour. Hopefully this was impactful and helpful for you. Michelle, did you drop the link in there for the
I did. Do you see it?
I just want to make sure.
Checking. Does everyone see it? It's 12:13 p.m. in the chat.
Just drop it in again. Because I don't see it, but it doesn't mean it's not going to be there. But just drop in the link. So if you want to get schedule a trust Dynasty trust evaluation, just go ahead and use that link, and we'll send an email out to everybody as well. And this recording is actually going to be on our YouTube channel. So make sure you watch our YouTube channel as well. We're going to put all of our Trust Tuesdays calls in there as well. So
I just dropped it again. Do y'all see it now? 1:05 p.m. Amanda at Prudent Wealth Strategies and
no. The other link.
PrudentWealthStrategies.com/Trust Tuesdays.
No. The scheduling link. the scheduling. Just check your email. It should be in there. If not, I can drop it in. I just have to
Hold on.
find
Go
it.
back.
1 second. Yeah, I got it. Don't worry about it. Oh, you know what? Yeah, why don't you do it? Because it's
Well, I have the Prudent Wealth Strategies Trust Tuesdays link, the Amanda Prudent Wealth Strategies link, and the Zoom link.
the OneSub meet link. Did you get that?
OneSub. Let's go to OneSub. Okay, I'm going to put that in right now.
Okay, because it's not showing. Letting me do it for some reason.
Hold on.
It's only letting me do for waiting. There's always issues with Zoom. Anyways.
Okay, how about now? Do you see it now?
Yes. Okay.
Okay.
All right. So yeah, so that's the link that you guys can click on and schedule a time with either me and Michelle to go over Dynasty Trust, either for yourself or for your clients. Kind of go a little bit more in detail and kind of see, what's going to work and take it from there.
Thank you.
All right, no problem. Thank you so much, and have a great day, everyone. Bye.
Thank you for joining, everyone. Have a good day.
Bye.
Thank you.